Well, welcome everyone. My name is Joel Schumacher, and I'll be your presenter for this particular session today. We will be talking about long-term care costs and protecting farm and ranch assets. And for those of you that don't know, long-term care is often associated with nursing home care. And we'll get into some of the details a little bit more, but that'll be kind of the topic for today. So just a quick background on myself, and then we'll go ahead and get started. So I'm a associate specialist for Montana State University Extension in the Department of Agricultural Economics and Economics. I teach a lot of personal finance things, and I also happen to be an accredited financial counselor. So we're going to talk about some kind of good things you should know and some tools, some knowledge that might help you create a better plan to make sure that your farm and ranch assets are protected in the event that you or a loved one ends up needing nursing home care for an extended period of time. So first of all, let's kind of define long-term care. You may see the term skilled nursing care or skilled nursing facility. That's kind of your traditional nursing home that probably many of us think of. There's also what we call assisted living facilities, which in some ways may operate much like a nursing home care, but may offer slightly less care and more independence to the residents living there. Generally, the residents tend to have a little bit more abilities of their own and may not need quite as much care. Rehabilitation facility is sometimes also used, and that could be either of the two above, depending on why a person is in the facility and the length and the care they're receiving there. You may also hear the term senior living center, which again could be a term just for a living arrangement, an apartment or a room that's targeted for seniors. Generally, that's not necessarily long-term care, but you may see that terminology. And then finally, I want to talk a little bit about home health services. And this is where some provider comes into your home or into the home of an elderly person and provides some care that allows them to live at home, that without that care, they may not be able to stay at home. So all of those services could qualify as long-term care costs, depending upon who's paying. An insurance policy, they may pay for some of these, they may pay for all of these, they may pay at different rates depending on the type of facility. You may also see some different terminology as well in there. So, but it is good to know some of the definitions so we can make sure we're all talking about the same thing. One of the things about farming and ranching is that farmers and ranchers oftentimes invest the earnings of their operation back into that operation. So you may have heard the term land rich, cash poor, because people take that cash and they purchase a new piece of equipment, they buy additional land, they pay off the loan on land. And often we see retired farmers don't necessarily liquidate all of their assets to cash, on a single day like retirement day. Some will do that, but others, may keep their assets tied up in that farm and ranch operation, even if they're becoming less involved with the day-to-day operation. Then these are two important points when we're talking about being able to pay for things and having cash availability. How many of you have ever heard something like this down at the coffee shop? We're going to lose the ranch because of the nursing home bills. Or the government is going to take our farm because of the nursing home costs for mom. Or we had to sell the ranch to pay the nursing home. Or maybe you had a neighbor say something along those lines. I've certainly heard this story, as I traveled across the state and visited with families, that these kind of stories come up, and I always want to know the details behind them and how much truth is in them and how much myth is in them as well. So we're going to talk a little bit about the processes that might have led to some of these comments, so that you can have a better understanding of that as well. So first, when we're talking about long-term care, let's take a look at how likely are you to need it. A recent study by the Department of Health and Human Services nationally took a look at those that are turning 65 approximately now, and they estimated how many of them are going to need nursing home care. And with this particular estimate study, they said, about 48%, so roughly half of people are not going to need any long-term care during their lifetime. So this individual, will live somewhere outside of a long-term care facility until the date of their death. Another 20% will need those services for less than 1 year. About 8% will need between 1 and 2 years of care. And then, 12% between 2 and 5 years. And then 14% of folks are going to need 5 or more years of care in this type of facility. So we'll talk a little bit about those last two groups. For those that end up needing care, so basically 50% of people, the average cost is $266,000 for long-term care over their lifetime for that. So that's a pretty substantial number. So we'll talk a little bit about some ways that you can plan for that and look at who pays for that as well. A couple other facts out of that study. On average, men are going to need about 1.5 years of care if you need care. And women are going to need an average of 2.5 years within that. So women plan for higher levels of expenses here than men will based on demographic and past data. So this is just a different way. We looked at how long people will stay in a nursing home. Now let's look at what they will spend on it. So again, 53%, or about half, are going to have less than $10,000 of expenses for long-term care. So if you're in that group, great. Planning for that's probably not going to be too challenging. About 20%, 19% are going to have between $10,000 and $100,000 of lifetime expenses for long-term care. But then again, we've got these two higher groups. 12% will have between $100,000 and $250,000 of expenses, and then 15% of folks are going to have over $250,000 of long-term care expenses during their lifetime. So again, the bottom three groups, maybe just the bottom two, are going to have a pretty substantial financial obligation that they need to make sure we're prepared to deal with. So one of the questions that I always get is, what does long-term care cost? Well, it's certainly, there's a range in long-term care, and oftentimes it depends on what level of service you're getting. So the more services you're being provided, the higher the costs are. From some of the most basic senior living operations, it's hardly any higher than rent. By the time you move up to full skilled nursing home care, you're talking about over $7,000 a month for care. As you can see, here's some averages. These are nationwide numbers. Actually, I correct that. These are Montana numbers. They came from a Genworth survey here for 2017. Again, about $7,200 for a skilled nursing home care. Assisted living is roughly half of that at about $3,650 a month. And then adult daycare or adult day health care, about $2,500 a month. And that's where the individual receiving care is dropped off during the day, but they're spending their nights, likely with a family member. There are variations on these. Again, if you have a double room, it may be slightly cheaper than if you have a single room. There are certainly differences in some of our larger communities in terms of, maybe how high-end the facility is in terms of finishes, how nice the lobbies are, those kind of things. And those type of facilities may cost a little bit more. In some of our smaller communities, we may only have one facility, so there may be just one option. And then home health care, again, it can range, but you're talking about usually between $40 and $100 per visit. So if someone is coming to your home, to help you bathe or clean your house or some of those kind of things, that could range quite a bit, and it depends on how often you're having someone come by as to what the total cost per month might be. But on the high end of this, certainly $7,000 a month is quite substantial. So who pays for this? So first let's talk about some different possibilities, and then we'll talk about what percentage of folks are utilizing these. So Medicare, that's the primary health insurance for seniors. So many people think that Medicare pays for long-term care. Medicaid, which is a program primarily provided to provide health coverage for lower income people. We'll talk about their role in this. There are some other, I'm going to call minor public programs. The Veterans Administration runs a few nursing homes, again, primarily for veterans and I believe their spouses. You can buy long-term care insurance, and we'll go over a couple examples of that. And then finally, out-of-pocket payments. This is just the individual or family is simply, writing a check to the facilities. So now that we've kind of seen who kind of the likely payers are, let's take a look at what percentage of total expenses are being paid. So first of all, Medicare doesn't cover custodial care. So if someone has Alzheimer's and they're unlikely to get better and return home, Medicare is not going to cover that. Same with a variety of other reasons a person might be in a nursing facility. Generally, Medicare is only going to cover it is if it's more of a rehabilitation service, and there's a limit on that. I believe it's 90 days or something as well. So this is, someone may have, let's say, fallen and broken a hip or something. They were in the hospital and they're ready to be out of the hospital, but they're not ready to go home. So they may go to a nursing home facility to continue their recovery for, a month or something. They might cover something along those lines, but they're unlikely to simply cover traditional long-term care needs. So about 10% of total long-term care expenditures across the country are paid by Medicare. So just 1 out of $10 comes from Medicare towards long-term care. And again, it's primarily these shorter stays where rehabilitation is taking place and the person is generally probably progressing towards better health. Medicaid picks up 45% of long-term care expenditures. Interestingly, and we're going to talk a bunch more about Medicaid, is this program is designed for low income and low net worth individuals. So they pick up a big chunk, but they generally pick it up when the individual does not have enough income to pay on their own and has no assets basically that are available to pay for their care, which because 45%, you see that big number, lots of individuals end up utilizing the Medicaid program. Are some other public programs that end up paying some. Veterans Administration is one. I've seen some limited cases where Indian Health Service had picked up some long-term care costs in very specific situations, but generally this amounts to less than 1% of long-term care expenses nationwide. So there are occasional situations where other agencies are paying, but generally that's not very common. Long-term care insurance is insurance you can buy specifically to pay for long-term care expenses. About 3% of total long-term care expenditures are covered by a long-term care insurance policy. Okay, so not a lot of people have these, but it's a reasonable amount, 3% of the total. And we'll talk about some quotes and a little bit about how those policies are designed in a few minutes here. And then 52% of long-term care expenditures are paid by the individual receiving care or their family. So they could be paying for that out of current income, things like Social Security benefits, maybe they have some retirement income, or maybe they're pulling money out of savings or selling assets or some combination of the above, or maybe family members are contributing funds for their care as well. So that's your largest contributor. Now let's step back and talk a little bit about Medicaid eligibility. First of all, because this program is designed again for lower income individuals, you have to pass tests to essentially prove that you're lower income and lower resource. And I'm just going to kind of hit some of the key points here, and I'll direct you to where you can get some more detailed information about this if you'd like. So you have to pass the assets test to be eligible. And essentially, you have to have $2,000 or less of what are called countable resources. And countable resources include things like cars, bank accounts, cash value of life insurance, stocks, bonds, IRAs, mineral rights, any real estate you own that isn't your home. And I said $2,000 there. If you're married, you get to keep $2,000, and your spouse, if they're not also joining you in long-term care, can keep 50% of your total assets up to a maximum of a little over $120,000. So if you had a $200,000 of countable resources total, $2,000 would be set aside for you. 50% of the remainder would be $99,000 would be set aside for the spouse. The remaining amount would need to be spent before you'd pass the assets test for Medicaid. If you do own a home, you can exclude that if your spouse is living in it, or if you reasonably expect to be able to return to that home at some point. And there is a maximum limit on that. You can see it's $560,000, so that may be excluded. You can also exclude income producing property in some cases, but the maximum amount there is only $6,000. So if you were thinking about you own some farmland, and you're getting rental income off of it, the $6,000 exclusion likely is not going to be high enough to cover expenses. In addition to the assets test, you also have to pass an income test, and essentially here an individual gets to keep $50 of their monthly income, or $90 if you happen to be a veteran, plus the amount of any health insurance premiums that you're currently paying, and the remainder needs to go towards your long-term care expenses before Medicaid would kick in. A community spouse is the spouse that's not going to be living in the long-term care facility. If that's the situation, any income paid directly to them is excluded from the income test, and then also anything that's jointly paid to both spouses, 50% is attributed to each spouse. So you have to pass that test as well. So just a quick example, on the income test, if an individual was making $2,500 per month of income, if their nursing home expenses were $6,000, the individual would pay $2,450 towards their long-term care. Medicaid would pay $3,550, and the individual could keep $50 to spend however they see fit. One thing I would say, the $50 seems quite low, but what I would also say is that when an individual is in a nursing home, they're not likely to have a large number of other expenses. They've probably sold their homes so that they don't have a power bill and water bill and a mortgage and those kind of things. So it's probably quite limited what their expenses are beyond the one large bill for the nursing home. Commonly, I've heard a number of people say, well, that's all fine, that, all this, but if I think I'm going to need nursing home care, I'll just give everything to my kids, and then nothing will be in my name, or I'll give everything to my wife, or vice versa to my husband, and then I won't have anything, and I'll be eligible, and then Medicaid will pay for all of my costs. Well, the folks that run Medicaid, they had those thoughts as well, and they've thought about that process. So they have a 5-year look back period on any gifts that are given, and those are counted as resources towards your eligibility even if you gave them away, say, a year ago. So just a quick example, John, who's going to be needing long-term care, gives $20,000 to his son. 6 months later, he applies to get into the nursing home, and he does a Medicaid assets and income test. At the time he needed that care, average nursing home cost, and this is a number published by the state that they use for this specific calculation, happens to be $6,819 a month. So essentially, John will be ineligible for Medicaid for 2.9 months after he would otherwise have been eligible. And the 2.9 months, the reason we get that is we take the gift of $20,000 that took place within that 5-year look-back period, and we divide it by the cost of nursing home care per month. And that determines how many months he would be eligible. So in John's case, if he was otherwise eligible the day he applied, Medicaid won't pay anything for almost 3 months in his case. So John will have to come up with enough funding to cover that before he's Medicaid eligible. So this plan of sort of giving everything away and then looking like you're poor so you can pass these tests, you need to plan 5 years ahead if that's the plan that you're going to utilize. Medicaid Also has a cost recovery program. So sometimes people own assets. Farmland or ranch land is a common one that have other family members involved, but ownership is still with that older generation. Medicaid doesn't necessarily make you sell that land immediately in order to pay for that. What they may do is actually place a lien on your property and then go ahead and make payments on your behalf rather than force you to sell it. But then when you do pass away, they have a claim on the value of that asset, likely land, that they could then enforce to go ahead and get the money back that they paid on your behalf. Now, let's say that you were going to gift that land to your children, and let's say that Medicaid paid $50,000 on your behalf. That doesn't mean the land has to sell to recover the $50,000. It could be that your heirs take a loan against the property. They take full ownership of the property and then make a payment to Medicaid to offset the amount of the lien. So a couple key points. Medicare, the health insurance plan, isn't likely to pay for most of your long-term care costs. Medicaid pays a substantial amount, but it's only for those that are essentially unable to pay for their own care. If you're a veteran, there may be some opportunities there for you to get low-cost long-term care in some specific communities in Montana. So now let's take a look at what those other two components are, which is two things that maybe you control a little more over, which is long-term care insurance and just private payments, or looking at out-of-pocket costs in terms of how you might fund long-term care costs. So long-term care insurance, this is a specific insurance policy that's designed for long-term care costs. So it's not part of your health insurance. And I would also look at it in the sense of you typically purchase it more like life insurance. You purchase it before you need it. So oftentimes between the age of 50 and 70, people are purchasing it. And as you probably expect, oftentimes people do not enter the nursing home until they're in their 70s, 80s, or even 90s. So you purchase the product well in advance of needing it. We could spend a lot of time talking about the details of long-term care, but I'm just going to kind of hit a couple of the key components. Oftentimes long-term care insurance policies have maximum daily benefits. So it might be they pay $50 a day or $250 or some number in between that. They may have an adjustment for inflation built into the policy. Again, if you're buying a policy today when you're 55, you may not enter that nursing home until you're 80, which would be 25 years later. Those daily costs may have changed quite a bit over 25 years. So inflation adjustments are somewhat common. Oftentimes they also have a maximum lifetime benefit, anywhere from $50,000 up to $1 million or more. Obviously, the more coverage you buy, both daily limit and maximum, will increase the cost of your policy. And then an exclusion period. So this is a waiting period before the long-term care insurance starts to pay. So you can think about this a little bit like a deductible. So if you enter the nursing home on January 1st, if you have a 30-day exclusion period, it won't be until January 31st that the insurance policy starts to pay for your care. So longer waiting periods will mean lower premiums now. And then also, if you are buying this insurance, make sure you understand what level of care that policy will pay for. Some may pay for only skilled nursing home care or assisted living facilities and not cover home health, So variety of different policies can cover different things, and it just makes good financial sense to understand what it is you're buying or comparing if you're comparing different policies. Just a quick example here. If we have a long-term care policy that has a 14-day exclusion period with a $100 lifetime maximum and a $150 daily maximum, if we say that Jill enters that nursing home on May 1st at a daily cost of $225 a day, from May 1st to May 14th is the 14-day exclusion period. So the long-term care insurance will not pay anything, and she would have to privately pay for that. And then on May 15th, long-term care insurance would start paying $150 per day, and Jill would need to pay the remainder, $75 per day. And this arrangement would continue for 667 days, at which point the policy maximum would be reached. And then the long-term care insurance policy would stop paying once that lifetime maximum had been reached. There's also a specific kind of long-term care insurance that's a little bit different. It's called long-term care partnership insurance. And your policy will have a specific endorsement that states that it meets the requirements for this. It has to have a few additional requirements than a traditional. One of them is inflation-adjusted benefits. There's some other minor things in there as well. If you're considering this, your insurance company can certainly explain the difference to you between long-term care and a long-term care partnership policy. But the reason the partnership policy may benefit farmers and ranchers is not only does it provide a benefit to the owner by having this daily or lifetime maximum that it would pay, it also protects an equal amount of assets from Medicaid recovery. So if you have a $50,000 policy, not only will it pay $50,000 out, if you then become eligible for Medicaid, and they will take $50,000 and essentially add it to your assets that are excludable when determining that calculation of whether you're eligible. So a quick example I think will make it a little bit clearer. Anne has her only assets are some certificates of deposits valued at $90,000. She had previously purchased a long-term care insurance policy for $100,000. So Anne enters the nursing home. She's able to pay the monthly cost between her income and the long-term care policy. After the policy is fully exhausted and $100,000 has been paid, Anne can pass the assets test without spending her certificates of deposit because she had that partnership policy and it excluded that $100,000 from the Medicaid calculation. So not only did the long-term care policy pay for her care, it also prevented her other $90,000 from being considered a countable resource. So if you think about that $100,000 as being the value of your ranch, this is a way we can protect ranch assets from the possibility of having very high long-term care expenses later in your life. People always ask, what does long-term care cost? And of course it varies. It's based on your age, your gender, your marital status, a variety of other things, just like most other insurance policies. The Montana Commissioner of Securities and Insurance Office is our state regulator for insurance companies in Montana. They publish a bulletin each year, and it has some sample price quotes in it. So I have pulled a couple of different samples out of this just to show you, and I will show you where you can get access to that full guide as well. So a $200 daily benefit with a 4-year maximum payment period, so it's phrased a little bit different, and then a 90-day elimination period, so that's kind of the waiting day period. For a 50-year-old, it would cost $179 per year with no inflation increases in that policy. If you want a 3% annual inflation built into those benefits, the policy premium jumps to $420 for a 50-year-old. If you were age 65, considering the same type of policy, it's almost $500 a year to start with for the no inflation increase, and then $851 if you do have that inflation component built into it. There's a lot more. You can see different companies' quotes, different age brackets also in this guide. So if you want to take a look, and this is a premium, not a one-time payment. This would be an annual payment that would go on until you passed away or entered the nursing home. Sometimes it stops at that point as well. So that's a rough estimate of what costs could be for this type of policy. So a couple of kind of key takeaway points in the summary. Long-term care is certainly expensive. Health insurance generally isn't going to pay for it. Medicaid will pay, but it's only designed for low income and low asset individuals. So if you're trying to protect ranch assets that are in your name, Medicaid is likely not a program that's going to help you pay for your long-term care. Medicaid recovery only, never more than the payments they made on your behalf. So the idea that they're going to come take the ranch, they're only going to put a lien on that property for up to the value of what they actually paid on your behalf. So if they paid $6,000 on your behalf, that's the lien amount that they're going to place against your property. Now, if they paid $600,000 on your behalf, the lien they're going to place on your property might be up to $600,000. So, and it won't ever force a sale. Your heirs will have the opportunity to pay that off so that they can keep the farmer ranch property as well. So planning for long-term care expenses is certainly an important part of a good financial plan. So if you're sitting down and planning for the succession of your farmer ranch, please include long-term care expenses as part of your thought process there. I want to point out a couple resources that I've mentioned. We did skim over some things. There's certainly a lot of details that matter a great deal when talking about long-term care. There are two things that I'd like to point out. First of all, Montana Commissioner of Insurance, Securities and Insurance. They have a consumer guide to long-term care insurance that they update every year, and that's on their website. I've provided the link. If you Google it, I think you will, or Yahoo search it, or whatever your favorite internet browser is. I think you'll find it quicker than probably copying over these long links here. But they have a rate comparison guide where they put out essentially year-old rates that you can take a look at. So those are two great resources there. And then MSU Extension, we have two Mont guides, which are informational guides that provide some information. One is on the long-term care partnership insurance in Montana. Some of the details there are available again here. I would recommend you just do an internet search to come up with that, or you can get it at msuextension.org. We also have one on Medicaid and long-term care costs that's also out there. So if you want some additional resources and to go over some of the things in more detail than we were able to today, those are some excellent places for you to do that. Finally, I just want to make sure that my contact information is here. This is my phone number here in Bozeman, 994-6637. Happy to take your calls to provide additional information on these topics. Also, there's my email, so please feel free to contact me if you do have some additional questions. I hope you've learned a little bit about long-term care costs and some different tools and ways that you might plan for paying for those in the event that you need those. So with that, wish you success with your financial planning, and thanks for your attention today.